The main thing we teach is not the insurance policy. We teach the process of moving your money and becoming the bank and taking back the banking functions, which is called the infinite banking concept. We just make money twice when everybody else makes money once. What's so complicated about that? They're putting more time into doing the things they don't want to, which is trading hours for dollars and working so that they can afford to live the lifestyle they want. All we're doing is changing one thing, and that is where your savings goes first. We're going to change how your money works for you. Welcome everybody to another wealth webinar where today we're going to teach all of you how to be the bank. And how we're going to do that is we're going to literally talk a little bit about the differences between the specially designed whole life and regular bank accounts. Because really, when you're looking to be the bank, what that means, the infinite banking concept, which is the process that we're going to use, what that means is that you need to learn how to take back the banking functions in your life. So one of the first things that you need to learn is how to change where your money goes first. Because if you just keep putting it into bank accounts, checking accounts, savings accounts, whatever, money market accounts, and that's tempting right now, is it not? I mean, Apple's got 4.15% on their high yield savings. I just heard Amex has one of their high yield savings at 4%. Your local bank might be 2 or 3%. So you're starting to look at it because you remember a couple of years ago where you got 0 on your checking and savings accounts, and now you can get 2 to 4%, right? So you're thinking, oh, wow, well, should I put my money in the bank account? Well, what we're going to do is we're going to first start with why you and the wealthy and businesses and so many other people, including traditional banks, and look it up, BOLI, B-O-L-I, bank-owned life insurance. We'll show you how the top 5 banks in this country, and I just mentioned the top 5, have over $75 billion in BOLI, bank-owned life insurance. And just for the record, I want to go clean on this. I want to come out clean. When banks buy life insurance, who on here can tell me what kind of life insurance banks buy on their vice presidents? What kind of life insurance do banks buy? I seem to think there's some people confused on YouTube and Instagram on what that is, but I'm sure all of you are smart enough. Right, Rick, whole life, right? Has anyone ever heard of a bank buying an IUL or a bank buying a VUL? Never once. Never once. You could Google it and you could spend the rest of the afternoon. You could get off this webinar and start Googling it to try to see if there's any banks buying IULs, and you will find 0. So it confuses me when I listen to some of these gurus saying they're doing infinite banking and saying they're using IUL. And not only that, stealing Devin's video and my video to then promote IULs. And then there's one gentleman, I'm not going to use his name, saying that banks are buying IULs. You know, there is really nothing you can do about that, but that is a blatant lie. Banks do not buy IULs. They buy whole life insurance for some very specific reasons, which are the exact same reasons why you should consider parking your wealth in a specially designed whole life. And Stephen, do you have that chart that we created? We created a chart because I like visuals. I'm going to draw on the board today, but Stephen put together a chart, and I want to have him share his screen as we talk through this. And I think this really, in the simplest way, sums up the difference between a regular bank account or regular savings account and a specially designed whole life. Because really, it comes down to the basic fundamentals of why would you do this, right? Why would you put your money in a whole life? Dave Ramsey, Susie Orman said that's the worst place you can put it.
You know, your money has to go somewhere, you know, so we always look at alternatives, like which is the best. So go ahead, Chris.
It's pretty simple. So all I want you to do, folks, is look at the screen, and we've got your traditional bank account on the left-hand side. And on the right-hand side, you have your BYOB bank, which is what? It's a specially designed whole life. So if we look at the top line, the single most important reason people put money in checking and savings accounts, liquidity. So banks provide liquidity of your money. If you need it, you can get it. Well, sometimes, right? Because how many of you during the pandemic or even recently have gone to the bank to try to take out more than $10,000 in one, swoop? Have any of you done that? Any of you gone to your bank, or during the pandemic? This happened a lot during the pandemic, or like Silicon Valley when the whole bank runs were happening. Did anyone try to take money from a bank above and beyond 10 grand? Can anyone explain to me what they went through when they tried doing that? Because we'll get all sorts of different answers. But did anyone actually go into the bank, tell them you wanted to take the money out, and did the bank just hand you the money without asking any questions? So Donna said she had to wait a few days. How about that? Rob, did you just go in and they just gave you the money right there and just said, all right, have a good day. Here's your dum-dum sucker. I just want to know if anyone else had issues. Ended up having to do an electronic transfer. Yep, because they remember all the digital stuff. Hey, we do have the Fed now. Fed now opened up. Okay, there's banks using this. So had to do an ETF. It was over a week later. Okay, so Rob had to wait a week for his money. Terry one time had to wait 12 days, over a week. So that's Terry. So all you can see, and you can, there'll be more coming in. Yes, credit union. Oh, now that's different. Credit unions, I like to keep them off in left field. They're kind of different than a traditional bank, even though some of us view them as a traditional bank, but they are not. Credit unions are the bomb. I don't mean to say that. If you're going to use a bank, if you have to use a traditional bank, which all of you will need to, even if you adopt being your own bank, you're still going to need a regular bank account. And I might suggest a credit union if you have access to it, because credit unions are phenomenal. They care about your relationship and they operate different than traditional banks. Same thing for community banks, although they're not much better than a traditional bank. But liquidity, right? Yeah, Stephen wrote in there, good luck. So now, how many of you have tried taking money from your specially designed whole lives? Has anyone in here done that? Yeah, USAA is kind of like a credit union. It's a membership only. And not everybody can get USAA. Landon, I've heard great things about USAA, but not everybody can get them. Okay, right there. So Teresa said, yep, fast and quick. Who else has taken a loan from their policy? Okay, Joe, okay, or a bunch of you. How long did it take for you to get your money? Did you have to fill out any forms? Did you have to get asked a bunch of questions like, sir or ma'am, what are you using the money for? Did you have to come back? Did you have to call the insurance company again? Okay, Mike said it takes longer than I would like. Now, on your first loan that you take from your policy, that usually will be the answer. Takes longer than I'd like. Okay, we always say immediately in the first 30 days, but the problem is if you take a big loan for your first one, a lot of times they want you to fill out a form. So I agree with that. Okay, but you'll see most of these people said, fast and quick, longer on my second and third. Okay, so we could get to Mike. I have 2 days, took 2 days for 10 grand, taken several loans over the past 3 years. One form in quick takes about 3 to 4 days for the money. Yep, we always say 36 hours for an ACH. Quick deposit to my bank account, online request, had check in 5 days. Okay, that was a check. 5 days later for a check to come through the mail. So you're really dealing with post office. So you can see, all I'm trying to say is right there on the top. Both of them provide liquidity of your money. Pros and cons to both. Some people would say, oh, it took longer than I like. Other people would say, yeah, the bank was a pain in the butt. But we can agree that both of them are liquid. So get rid of that. The second thing, how much do you make? So your bank account, what we did is right before we created this, we actually went on and looked at the nation average. Now, this is going to vary, but that's the nation average right there. Okay, 60 basis points. Okay, so and if you don't know that, that's Wall Street talk. It's basically 60 cents. Well, not 6%, but it's 60 basis points. I guess that's the only way I know to say it. A little over 0.5% is what people are getting as a nationwide average. Now, what's everybody else getting? Anyone else getting good interest from their traditional bank? Not one of the high interest rate Apple savings or Amex savings, like your bank that you walk into. What's everybody getting out there? I just want to gauge the audience. And folks, I love that you're all putting questions in the Q&A. We will answer each and every single one of them once we get through this. Anyone else getting any good interest rates? 2.65 is pretty good, Carla said. Credit union is 2%. Typically, credit unions are going to be higher. Okay, money market 1.9. So you can see, if we ask, some people are going to be higher than the nation average. But again, you're noticing their credit unions, their money markets, and typically high interest savings accounts, which are more of a money market type account. So right there, okay, 1%. But that's the average. So in your policy, I think we can all agree right there. Every policy that we write, the lowest guaranteed interest that we get is 2%. Okay, and that's Lafayette. Every other company we deal with is north of 3%, guaranteed contractually. Now, some of you might say, yeah, but I can get 4% with Apple. So why would I go with something that's, 3.25 when I can get 4 with Apple? Here's the reason why. How many of you have ever gotten, Ally Bank many years ago had, great interest rates, over 4%. But then all of a sudden, when the Fed dropped interest rates, what happened? Ally Bank paid next to nothing. The same thing happens with all banks. Banks float. Keyword. Your bank account, whatever rate you're getting, 1%, 0.5%, 1.9, 2%, that's a floating rate. So your interest rate is going to vary based on whatever Jerome Powell decides, which the good news is your bank accounts. Today, we're going to actually we're going to post what Jerome Powell is going to do with interest rates. Now, we pretty much already know they're going to raise them another 0.25%, okay? Which means, by all intents and purposes, banks should start paying you a little bit more in interest. Great thing, right? Treasury bonds pay you a little bit more in interest. But here's the thing, they float. When we look over at the interest rate inside the specially designed whole life, whether you make 2 or you make 3.25 guaranteed interest, that is locked in for the rest of your life. So it doesn't matter if rates go high. It doesn't matter if rates go to 0. It doesn't matter if rates go negative. Remember the talk of negative rates? Yeah, that can happen. But it doesn't matter. You're locked in at that rate. And not only that, that rate compounds uninterrupted right there. Stephen got a big check mark there. Uninterrupted compounding. And then if all we do is we add the dividend. Now, the only reason I didn't talk about the dividend in the first part was because I was talking guaranteed interest rate contractually. Dividends are not guaranteed. However, every company we deal with has paid dividends every single year consecutively, never missing one, for well over, I think, well, let's just say over 120 years. Most of them are like 140 to 160 years. Never missed one. So why would they miss one now if they didn't miss one during the Great Depression? Why would they miss one now if they didn't miss one during the Great Recession? Why would they miss one now if they didn't miss one during the pandemic when banks went to 0 and weren't paying anything, right? So if you include the dividend, you're up around 5.5%, like Stephen put on there. Compounding, uninterrupted, which I didn't really get too deep into that, but we will in a second. But let's just keep going, because now we start to really see the fork in the road between the bank account and the policy. See, the bank account every year is taxable. You all know this. In your bank account, if they pay you 0.5, okay, 1%, 1.9, 2%, you're going to get a 1099 at the end of the year for the interest you got. That's right. You're going to pay tax, and tax is one of the biggest eroders of wealth that there is. Stephen talks about it all the time, you know, unhappy smiley face. But over here in the policy, as long as it's designed properly, and folks, when we design your policy, I can make a promise to you. We will never make your policy taxable unless you screw it up, ever. We know how to design these policies, and we know how to do it the right way, which is basically so that your policy is not a MEC, which is under IRS terms, the MEC 7 pay rule. We will make sure it's not a MEC, which means your policy will grow tax-free. Continues compounding when using the money too. Remember I said uninterrupted. Some of you didn't connect the dots. Let me just give it to you this way. If I put $100, or let's do 10 grand. If I put 10 grand into my policy immediately starts compounding daily. Okay, remember that guaranteed interest rate starts compounding daily. And then one time a year, we get the dividend. But let's just say I put 10 grand in and I take $8,000 out and I use it to pay off a credit card. How much money is still in my specially designed whole life compounding and earning interest? The full amount, right? So if I took 8 grand out of the bank, if I put 10 grand in the bank and I took 8 out, how much is in the bank, you know, compounding? 2 grand. The difference, it's like, well, yeah, duh, 10 minus 8 is 2. So the traditional bank is paying you on 2. The policy is paying you on, well, the full amount in your cash value, always. That's uninterrupted compound interest. So tax-free, okay, next. In your bank account, I don't know if any of you have ever been sued, but I have. And one of the first things attorneys will ask, don't give it to them unless you're forced to give it to them. How much money do you have in banks? How much money is in your bank account? So I'll ask you for an asset report. And the very first line in any lawsuit is, how much money do you have in banks? Does anyone know why they ask that? It's called low-hanging fruit. It's the easiest money for a lawsuit or an attorney to lock up. And if any of you have ever won a lawsuit, which I also have, I've sued roofers and won lawsuits. And then what do I try to do? Lock up their bank account. I go right after their bank account and try to garnish it. Why? Because it's unprotected. Your bank account is unprotected. Now, I know most of you will probably never have a lawsuit, but if you're in real estate, you will be sued. I hate to bring the bad news, but if you're in real estate, it's not whether or not you're going to get sued. It's just when and how many times. That's it. Hands down. So it'd be better just to play the protected game versus the unprotected. So over on the whole life side, okay, they are protected from judgments and lawsuits in most states. Okay, and that is most states. Now, this is interesting, especially, when you look at some of our clients, a lot of real estate investors, a lot of entrepreneurs, a lot of doctors and surgeons and anesthesiologists and professionals and dentists, and I could keep going. But you notice one theme across the board is any entrepreneur, real estate investor, surgeon, professionals, anyone, they have a higher risk of being sued. Why? Well, it's just their profession. And who gets sued more? People with money, right? Everybody wants to take what you have. The higher up the flagpole you get, the bigger the target on your ass gets, right? Brent Kessler line. The higher up the flagpole you get, the bigger the target on your ass gets. So I'd much rather have my money in a protected place where if I get sued, that's off limits. They can't touch my whole life. That money is protected against judgments and liens. So piss off, like Stephen drew a middle finger. Nice touch.
I'm glad you picked up what that was.
His drawings are on point, Rick. Totally on point. But let's keep going. Okay. Down here, we already kind of hit this, so I'm just gonna go quick with it. Bank accounts are unstable. You've all been through this cycle. You're making a bunch of interest. They're 4%. Let's just use, and then all of a sudden something happens and you're making next to nothing. Unstable. So policies throughout the history of all these insurance companies, they have maintained stability in times of economic uncertainty. They've always paid dividends. The interest rate cannot change. Therefore, you've got a place to park your capital that has stability. And that, I'll tell you, is a tough thing to find these days because you're not getting stability in the markets. You're not getting stability in money markets. You're not getting stability in stable coins. Remember when stable coins were unpegged? If you're a crypto person, we're unpegged. Some of you are like, I don't even remember that. Well, it wasn't that long ago that we had a bunch of people coming on our show saying, oh, they should just put their money in a stable coin that's pegged to the US dollar. Until it wasn't pegged to the US dollar anymore. Instability. Well, your bank account's no different. Oh, and the last thing I know.
Also, Chris, real fast, also about 500 banks failed during the 2008 financial collapse, where I believe there were 0 mutually owned insurance companies failed during that time. So additional stability there. Absolutely.
And the very last thing is the bank doesn't, if you got 10 grand in the bank and you die tomorrow, your family gets 10 grand. Oh, wait. Actually, your family might not get 10 grand. Because the one thing I didn't put in here is bank accounts are subject to probate. So if none of you have ever gone through probate, well, just read up on it. But for any of you that have lost somebody and had to go through probate, you will find a new hatred for the people surrounding probate. You'll find a new hatred for the courts. You'll find a new hatred for the attorneys taking you through probate. It's not a fun process. I have dealt with it with my grandparents. They didn't have a lot of assets, but it went through probate. Probate and all the stuff that goes around that whittles it away. So it's probatable assets and there's no death benefit. If you had 10, your family should get 10 if it doesn't get wrapped up in probate. But you see with the policy, if you put 10 grand into a policy, I'm going to tell you, even with the ones we design, which have really low death benefits, you're probably going to have a few $100,000 paid out to your beneficiary. So take yourself out of the equation because I'm going to kill you off right now. You're going to graduate, okay? And you're going to go on to a better place. Would you rather leave your family in a better place or a worse place or the same place they're in now? Don't answer that. A better place, right? So a tax-free death benefit that leverages the amount you had in the policy by, let's just say 10x, wouldn't be such a bad thing, would it? Or even if it was 5x or 3x, still would be way better, right? Tax-free, bypassing probate. So Stephen, you can just draw the middle finger here again because probate can beep off. You guys all get the drift. So as you can see, when we look through these different things, you then can make a really solid assumption that, okay, where do you want your wealth or your savings to go? Now, I'm not talking about all your money here. And that's something that I think is very important to call out. We're talking only about the money that you save. Today, all of you are saving money in one place or the other. Some of you are putting money in a 401k. I would urge you to really look at your 401k and decide, is that in line with what your needs and goals are? I will tell you, most people, it is not. And if you are putting money in a 401k, there's reasons. Usually it's for tax deductibility. Remember, if you're putting money in a 401k to get the tax deduction today, you're going to then take the money out someday later, 5, 10, 15, 20 years later, and you're going to pay more in taxes when you take the money out because there's no way tax rates are going to be as low as they are now in 5, 10, 15 years. It's just not. They're going to be higher, right? Can you all agree that taxes are going to be higher? Okay, so when you're really looking at where your money goes, 401ks, I would say the only thing you should be putting in a 401k is whatever they match you up to. If they match 3%, great. If they match 6%, great. That's all you should put in. Take the rest and change where that money goes. But a lot of people, from our experience, and we have a lot of experience with our Money Mentor team, we've talked to thousands and thousands of people, many of you. So we know where people are putting money. And most people, surprisingly, are putting money in bank accounts. That's where their savings is going. And to the tune of some people, some of you on here, I'm not going to name any names, but when you look at your bank account, you have hundreds of thousands of dollars in your bank, or I should say you did, okay? And some of you, well, you had millions of dollars in your bank account. Now, I want to come over to one question that's here from Nancy, and I don't know what this is relative to, but Nancy mentioned this money is in a bank, not FDIC insured. So I think what Nancy's referring to is if we really were going to keep doing a comparison between bank accounts and insurance policies, someone could make the argument, oh yeah, but my money in the bank is FDIC insured. Now I could punch holes all over the place on that, and I have in many videos, but let's just take it at face value. Correct. The bank gives you an FDIC insured amount of 250 grand. So if you got less than 250 grand in the bank, well, the Fed or the FDIC, which is an insurance company run, we don't even know who it's run by. Hell, it could be Satan, but we're not going to go there. So anyway, the FDIC is guaranteeing up to 250 grand. Now, remember when Silicon Valley Bank went bankrupt? Oh, and then Republic and Signature. And what was the other one? UBS, I believe it was. And there's a bunch of other ones that you never heard about. But when those all went, what did the government do? Printed money. I could show you on the money supply chart from the Fed, I could show you the spike when the Fed had to bail out the banks. And why did they have to bail them out? Well, because people obviously don't read that little placket when they make deposits that says anything over 250,000 is not guaranteed. But Nancy's correct. Insurance policies and insurance companies do not have an FDIC insurance little placket. So when you put money into your policy, you're not going to see a little placket that says your deposits are insured up to $250,000, which actually should be good if you understand what is insured, because you're dealing with an insurance company. So how much of your money is insured? Well, all of it. Because we get a question all the time. People are always like, well, what happens if the insurance company goes bankrupt? And I always urge people, okay, so valid question. Why don't you do some due diligence and just Google mutually owned life insurance companies that have gone bankrupt? Go back to the beginning of insurance companies and tell me how many of them have gone bankrupt. Then you might find like 5 or 6. I don't know. I haven't done it or counted, but there's barely any. Well, how many went bankrupt in 08? Because you already know that.
From 08 to like 2012, there's like 500, give or take.
Okay, 500 banks went bankrupt during that time frame. And I bet you probably can't find 5 mutually owned life insurance companies that have gone bankrupt since the Great Depression. I bet you can't find 5. And maybe someone can because they're going to spend the time to do that. But I'm just saying, you're not going to. This year, 3. What's that? This year,
3.
Oh, 3 alone this year. 3 banks alone this year have gone belly up. How many mutually owned insurance companies have gone bankrupt this year? 0. So let's go back to 08, okay? Because that's the closest reference. You all may remember an insurance company did go bankrupt, okay? AIG. Now, I get people sometimes that bring this up. Now, I want to point out one very gleaming fact about AIG. They are not a mutually owned insurance company. They are publicly traded. Why did they go bankrupt? Because they're publicly traded, and because they were a risky driver, and because they were insuring things that you can't insure 120% of what the value was. So they went belly up. But how many people lost money with AIG? How many of the policyholders that owned universal life policies with AIG or had money in annuities with AIG? Can anyone tell me how many of them went or lost money with AIG? A publicly traded insurance? That's right, Deborah, 0. Well, how can that be? Well, because these are insurance companies, which are far bigger than banks. And because insurance companies, they don't just have FDIC, they have federal and state protections, and insurance companies have money. Imagine that. An insurance company actually has money to pay off all their people. It's right, because they have to operate under Austrian economics. Not like the banks where you put a buck in a bank, the bank has to keep 10%. That's it. Banks are a house of cards, which is why they go bankrupt so much. They're a house of cards and they take a lot of risk. Insurance companies, ultra conservative, they have the money because of Austrian economics. If they promise you $1, they have to have $1 in assets. Look it up. I'm just giving you the facts, folks. So when you're really looking at the protections and the security and the safety of where your money is going to sit, I think we've done a pretty good job. There we go. Lauren put something interesting stuff. I don't know what it says. I'm not going to look at it, but insurance companies have lots of eyes on them. Well, Tess Tess used to be in the accounting department for giant insurance companies, and she'll tell you that they're not going belly up, okay? Because number one, even if they were, let's say they were a super tiny small insurance company, and if they were, we wouldn't use them anyway. But let's just say they were, and they ran into financial trouble. Tess, I'm not going to answer this, but Tess, what would happen if an insurance company started getting into trouble, and how long would it take for the problem to be fixed? I already know the answer because me and Tess have talked about this. Another insurance company would step in and buy them out very quickly. It would never make it public, and there would be zero, no one would even know. No one would even know because it would happen so fast and so seamlessly. You see, all the insurance companies band together. Banks, not so much, as you can see. Yes, I know, there was some bailouts of banks even this time around. They sell the company and pay out all claims. State regulators appear within a week and tell you that you work for them. Insurance companies have lots of eyes on them. So there we go. I'm just trying to point out some of the obvious things. So when you're really looking at where you store your capital, it's pretty easy to see why we're always talking about insurance policies with giant mutually owned insurance companies that pay dividends. But that's not what we teach. You see, the main thing, I just had to get that out of the way. The main thing we teach is not the insurance policy. We teach the process of moving your money and becoming the bank and taking back the banking functions, which is called the infinite banking concept. And it's very simple, folks. There is nothing complicated about what we teach. You all do it every single day, except for you're giving your money to the wrong person. Now, let me give you an example. If any of you wanted to buy a car today and you are brand new, do we have anyone brand new here? We got 145 people. Is there anyone brand new that has never been on this? Put I in the chat. Perfect. So some of these folks have probably never heard us talk about the infinite banking concept. They've never heard us talk about this stuff. So this is brand new. So I just want to kind of go back to the basics. Remember Michael Jordan, okay? Michael Jordan, every time he stepped foot and all of you could argue that he's the best basketball player of all time. Every time he stepped on that floor to practice, he practiced the basics. So let's go back to the basics. If any of you wanted to buy a car, what would you do? Well, you'd probably either save money up in a savings or bank account to pay cash for the car, or you'd go to the car dealer and you would finance the car or lease the car, right? This is just the ways. Some of you might steal the car, but I don't know if there's anyone on here that's stealing cars. You're right, he was the best, Jim. But that's how you'd buy a car. So if you finance the car or lease the car, I want to ask you a question. Whose name do you write on the check? It's a pretty simple question, right? The bank, whoever the finance company is. Ally Bank, Wells Fargo, GM Financial, Mercedes Financial, you write the check to them. And they take the check and you get to drive the car until you stop making payments. Then a tow truck comes in the middle of the night and takes the car, or your lease ends and you got to hand the car back in, right? That's how it works. So just think about that right there. How much money throughout your lifetime will you give away for the cars that you drive? And let's just talk interest. I don't expect an answer, but a lot, right? So all the infinite banking concept would do was change the dynamic of that. Right now, you write a check to somebody else's bank. So now let's just reverse the order. You want to buy a car and you want to finance the car. So you take a loan to finance the car, just like you do today. And when you finance the car and you get the car and you know all this, you have to write a check every single month, except for now, you're going to write a check to you. You're going to literally write your name, well, not really the insurance company, but your name, let's just pretend to keep it simple. You're going to write your name on the check. And the check is going to come back to you because legitimately you are going to write the check to you. I want to ask you, how many of you would prefer to write your car payment to yourself versus Ally Bank, Wells Fargo, GM Financial? How many of you? Put it in the chat. Would you prefer me? Put me in the chat. Yeah, it's a logical question. I mean, but some of you are then thinking, that's too good to be true. And then I would say, is it? Because I will tell you, for all the cars that I bought for quite a while, the check I write every single month, I write the check to myself. I truly do. It's an automatic transfer, but it's the same thing as writing a check every month for both of my vehicles. If we drive nice vehicles, I'm not touting or tooting the horn, but like those checks come back to me every month. And you know what that check includes? The exact same thing that the check used to include when I wrote the check to a bank: principal and interest. So I recently just bought a new vehicle for my wife because the one she has 60,000 and it's making, every vehicle when it gets to 60,000, it makes those creaks and those clunks and, she goes over bumps and it's rattling and she's like, oh my God, it's so dangerous and I got to drive Vivi around. she plays the game well. So she's getting a new car. So we're financing the new car, right? So I found the car she wanted, beautiful vehicle, and we negotiated the deal with the dealership, got the price. I even had them run the financing. So I had them run all the numbers for the financing. It was like $1,100 after the trade-in, because we're trading her clunker in and we're getting this new one. So the payment on this new vehicle is $1,100. So when we got done, the $1,100 is not going to be paid to Wells Fargo or Ally. The $1,100 will be paid to us. Why $1,100? Well, because that's what the dealership came up with, the principal. And how much is the interest rate? 7.79%. Why 7.79? Well, because that's what Wells Fargo charges. So why would I charge my bank any less? Or why would my bank charge me any less than Wells Fargo charges, right? It's, if I'm going to pay 7.79% to any other bank, and I searched for the best rate, hell, Ally Bank was like 9%, but 7.79 was what Wells Fargo gave us an offer for. So that was my rate. And then I ran a calculator, bankrate.com. I'll show it to you right now. Hey, folks, I'm trying to teach you that what the infinite banking concept is so simple, because it's exactly what you do now. It just changes who you write the check to. It really does. So car loan calculator. I just want to show you how simple this is. And then I want to get into some numbers today, and I want to hit these questions. So bankrate.com, this is the one I always use, okay? So I think the amount we financed after the, and I might not get it right, and I did 72 months. Of course, it doesn't give me, so we'll just do 60. I did a 72-month loan, 7.79%, 1372. So why would I have done this? Well, this is how I figure out what my monthly payment's going to be. So total principal paid will be $68,000, total interest paid. So if all of you did is use the infinite banking concept and use these policies just to buy cars, just on this car here, a $68,000 automobile for 60 months at 7.79, I would pay myself $14,318 in interest. How many of you want to make $14,318 in interest for driving your car? Every one of you. But you see, I could even go one step further, folks. I could go and I could find, let me pick somebody. Jackson, I'm just going to pick on you, okay? Because I see your comment. I'm going to find someone like Jackson who needs some money for his business or for his real estate deal or whatever he needs money for. And I'm going to figure out how much money do I need to give Jackson so that Jackson will write checks every single month to pay for my $1,372 payment. Let's try this. Bankrate's got all the good calculators. All right, so loan amount. Let's see what it cost me. 100,000. Let's do 30 because it doesn't matter. And Jackson maybe pays me 12%. I'm getting close. So Jackson might have to pay me 15%. I'm getting closer. I might have to give Jackson 120 grand. See all I'm doing? I'm figuring out how much money do I need to give Jackson. So, and at what rate do I need to charge Jackson so that Jackson makes my car payment? Because I don't want to make my car payment. So you get the drift, right? All I'm doing is just trying to show you. You just reverse engineer it. This stuff isn't hard. But the thing that's different is, number one, it's how I use my money. That's it. Everything we teach really comes down to the simple fundamentals of how do I make my money work for me? I did two different ways. Number one, I could take the loan from my policy, pay for the car, and then make the car payment, the $1,100 or whatever it was, back to my policy. I'm writing a check to myself, like I told you I do. Or I could take the money that I have saved up for the car. I could find someone like Jackson who might pay me 12 or 15%. I give Jackson $110,000. I charge him 13 or 14% in first secured position. Jackson makes a payment every single month that pays for my car. You see, I just did two different things there, but both of those things included one thing that most people out there, most folks are not doing. And that is, my money is working for me. See, most people will go out and work for money. They will trade hours for dollars. And when they trade hours for dollars, you know what they do? They give up their time. The most valuable resource every one of us have. They give up their time. And then what they do is they take that money that they make by trading their time and they exchange that to the car bank finance company in a monthly payment to drive the car. They gave up their time, which means less time with their family, less time with their children, less time doing the things they want to. That's right. They're putting more time into doing the things they don't want to, which is trading hours for dollars and working so that they can afford to live the lifestyle they want. We just changed that by making our money work for us. let's get into some of these questions because I want to make sure we hit questions as we're going. And then I want to show some of the math and the numbers around the infinite banking concept, since we kind of went back to the basics. Does everybody understand what I just explained about? I just did cars. Does everybody understand that, especially all of you that are here for the first time? Did that make sense? I know there's pieces missing, but we're going to fill those in. I've been paying full price and then paying myself. Yeah, so Keith, great. Listen, look at that comment. I've been paying full price and then paying myself back. This is the piece that I was missing. See, when you do this, when you change where your money goes first and you become the bank, does it matter what you pay for the car? I know so many of you love to go out and negotiate the car, but in this case, Stephen, does it matter how much we pay for the car? Like, could I overpay for a car by $29,000?
Yeah.
Would it make any difference at all?
No.
None. Because I'm going to get all the money back for the car no matter what. So if I pay $29,000 too much for the vehicle because I really want it, true statement, I think I overpaid for my truck, that's okay, because the payments I make come back to me. I make payments every month, they come back to me, and because of that, I get all the money back. So it doesn't matter that I overpaid for the car, kind of like what Keith said. Yes, Jackson, I'm going a little fast, but we're going to come back to it. I'm just trying to help you understand that all we're doing here, folks, this is so simple. All we're doing is changing one thing, and that is where your savings goes first. And then all we're doing is adding one step. So everybody on here can do that. You can change one thing, and that's where your money goes first. And then the second thing that you're going to change, but it's really an add, is you're going to change how your money works for you. That's it. We're going to change how your money works for you. You're no longer going to buy cars by taking a loan from somebody else's bank. You're going to take a loan from your bank, and you're going to make payments back to your bank. It's adding one step. That's all it's doing. There's nothing complicated about this. Matter of fact, our team, if you use us to do this, we do all that work for you with our mapping team.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris.
All right, Stephen, let's get into some of these questions and then get into some numbers just so people can really see how this works.
Yeah, definitely. And just so you know, I just had somebody buy a VIP ticket. So we only have a few of those left for Money Tank next weekend. I think Shauna said we had 5, so one's gone. And her son is in military at Fort Bragg, and he can only come Saturday. So I told her, bring him along. Don't even worry about it. We love our military people.
100%.
All right. What were we getting into?
Well, let's hit some of these questions because I see a lot of stuff. And folks, if you're asking questions, I see some of them going in the chat. We might miss them in the chat. So if you really have a good question, please put it over in the Q&A. Like George here says, I have $53,000 to borrow from my new policy. I have a car loan that is $17,000 and a home mortgage at $345,000. How would you approach this?
All right. So George, yeah, $53,000 to borrow from a policy, a car loan at $17,000. And a home mortgage at $345,000. How would you approach this?
So let's just draw these out. Like that's the easiest way to do it. So car loan is $17,000. There's a couple things. I'd need to know what the interest rate is and what the monthly payment is. But 17 grand, let's just say it's $300 a month, and let's just say your interest rate's 5%, right? We're just going to make numbers up here, and if you want to give us the numbers, George, just put them in the chat. And and then he's got a mortgage for $345,000. Now, again, I would need to know interest rate and I would need to know monthly payment. So those would be some of the factors that I would need. And they have $53,000. So they started a policy. Okay. So over here, we got the specially designed whole life. And let's just say they put $60K in. I don't know the math, but I'm just making that, because if there's $53,000, they probably put 60 in to have access to 53. Because in the first year, you're not going to have access to 100% of the money you put in. Insurance companies do have a cost for the insurance. So we need to factor that out. So what would I do? Well, first, I would get rid of the car payment. So I would take $17,000 of the cash value as a loan. But remember, if he's got $53,000, when we take $17,000 out, the 17 isn't coming from his 53. So let's just do this. Okay. What we're first going to do is we're going to take a loan from the policy for $17,000. And the insurance company is going to charge him right around 5%. A little bit less or a little bit more. The loan right here for $17,000 that's taken, remember I said it doesn't come from your cash value, so I'm going to get rid of that. Where does it come from? It comes from your death benefit. The insurance company is going to subtract $17,000 from George's death benefit. They're going to take and lock up 17,000 of the cash value for collateral. Okay, so he will have access to 17,000 less in cash value, but the money didn't actually leave, which means if he's earning 5.5% interest and dividend, he's still earning that on the full 53,000 because the 53 never left his account. The 17 came from the death benefit, so the 53 just collateralized it. So we took the loan from the policy, which we already did this earlier, took roughly about 36 hours to get that.
The car is 3.3% and it's $395 a month.
That was close. 3.3%. Let's do this the right way. 3.3% and $390 a month. So now what this is very simple. So this is what we just talked about. Change how your money works for you. So he took the money out, 17,000. The car loan is paid off. But see, he can't stop there. That is never being an honest banker. So the next step of what George is going to do is he's going to take this $390 a month that he was giving away, which is, I know it's only 3.3%, but that's fine. He would take that 3.3% and set up a loan repayment to his bank. So now he's getting $390 a month, which works out to be about 3.3. And some of you, I know what you're thinking. Some of you are like, wait a second, Chris, hold on. He's paying 5% and he's only recapturing 3.3. Like that doesn't make sense. Oh, it makes all the sense in the world. It makes all the sense in the world, not the way you think, but you have to understand that this is 5% simple interest and this is 3.3% simple interest. Okay. But over here, this is 5.5% compound interest. So we really got three interest rates we're talking about. One is compounding. The car loan is simple interest. Insurance company loan is simple interest, and so is the car loan. So really what we've got here is if we took 3.3% from the 5, we technically would look like it's costing us money, but it's not because you're still earning interest on the full amount. So you're winning here, you're losing there. But what you're gaining is $390 every single month that you didn't have before you did this. But see, we didn't use all the cash value. Plus, he's now got $390 refilling. So we'll just do some quick math. If you just do the math on it, $390 times 12. So every single year, he's adding back $4,680. That's money that was just given away. That's money that left his family forever in the old way of doing it. So now that he paid the car loan off and he did it with a loan from his bank the whole life, he's now able to take back $4,690 a year. Plus, he's still saving money every single year into the policy. Plus, his policy is still compounding at the full amount. So he is coming out ahead. But then what he would do is he would take the difference. So we had 53,000 to start, George. We took 17,000, so we locked that up in collateral, but that means you got 36,000 left. So what we could do, and I probably would not pay the mortgage off, okay? But if we took 36,000 bucks, so let's do another loan here. I'm going to do it a different color. So this is loan number 2, 36,000. If he took the 36,000 and he basically went on to Private Money Club, there's got to be a deal on here right now that I can show you. Let me share my screen here real quick because hey, I haven't looked at this, but let's do real time. There's got to be a deal for 30-some thousand bucks. Let's see, can I get lucky? 35 grand. Okay, let's just pick this one. Whether this is the one you would do or not doesn't make a difference. It just matches the criteria. So they need 35 grand. They're willing to pay 12%, second position. Now, again, this might not be the deal, but now I found a place for 36 grand to go to make me 12%. Okay, that's all I'm trying to demonstrate is just we went on Private Money Club. We found this deal, whether it's the one you actually do or not. I just wanted to kind of give you a demonstration that there are deals for 35 grand. So now let's do 36 grand times, well, here, let's just do 35 times 12%. Whoops. 35,000 times 12%. 4,200 bucks. So now what I just did is I just created out of thin air another $4,200 a year, which works out to be 350 bucks a month. Isn't that kind of fun? All we did is we sent our money to work. We paid the car off, which brought back 390, and then we just lent the other part out, and that's another 350 bucks. So George literally just created money out of thin air by taking back the money that he was giving away and putting his money to work. That's a great way to do it. But George, over time, you would probably eventually start to work toward this, but we would just build the bucket. Because remember, all this money's coming back. So now you got 350 coming back, 390 coming back, plus your savings, this is going to keep building up. You know, you're not going to have 53. Eventually, you're going to have 60, 70, 80, 90. And then we can start chunking this down. Great question. Sorry I went long on it, but it was a really good way for me to show it. When banks put a whole life policy on a vice president and the vice president leaves the company or is let go, I assume the bank keeps the policy and uses the money and maybe uses it to leverage and get more money to loan out. Of course, yeah, banks, when the VP leaves the company, it doesn't change the bank. The bank owns the policy. So when that employee dies, as long as his significant other remembers that he had life insurance through the bank, the policy will pay out. The majority of the death benefit will go to the bank because they own the policy and they're the beneficiary. And a small amount, whatever was promised in the VP's contract, their executive benefits, would be paid to the executive, usually 50 to 100,000. Do credit unions use fractional reserve banking? Yes, they do. They do. They do things differently. Remember, it's a membership. A credit union is a membership only. So they just have different offerings, usually better interest rate, lower loan rates. Nancy said interim.
Nancy, hang on real fast. So Nancy's had a multi-part question going here. She has, I guess, $1 million in a bank that they're waiting on settlements. There was a fire in the condo, so 17 units redone. 3 units were totaled. So the $1 million is sitting for a couple months and wondering if there's something she can do with it.
Yeah. So if I had $1 million and it was sitting in, you know, if you need all $1 million, but it just sounds like this is going to be a renovation. All right. You got the money sitting there. And eventually, once you start doing it, that money should be earning something. I got a couple of choices. So first thing you could do is, and this is what I would personally do, I would go out and I would find some short-term, like 2-year, or it may be even 1-year treasury bills. Stephen, can you just look up real quick? What do 2-year treasury bonds pay right now? Or bills? Because they're all pretty good. Or 2-year treasury bonds.
2-year treasury.
And the reason I would do this.
4.9.
4.9 for 2 years. Okay. And then what do 1-year treasury bills pay? Probably 4%.
Year.
Or any short-term T-bill.
5.4.
5 point. Folks, I want all of you to really look at that and wake up. This is backwards, folks. This is so backwards. Why in the world would a 2-year duration bond pay 4.9 and a 1-year bill pay 5.4? It's because it's inverted. It's because we're headed to something really bad. That is a telltale sign. But anyway, who cares? Because for Nancy, this is great. 2-year treasuries, 4.9. 1-year T-bills, 5.4. Bingo. That's where you put that money. Split it up. Do 500 and 500. And then when you need the money, so here's the reason people don't do this, okay, is they look too deep into this. They're like 2-year and 1 year. Oh, I need the money before 2 years and I need the money before 1 year. Treasuries and T-bills are the most liquid investments you can ever put your money in, and they're guaranteed by the full faith and credit of the United States government. And if you look at a chart, and I'm going to get into this in a little bit, you can buy them at the lowest prices they've pretty much ever been, because interest rates going up are good because the price of bonds goes down. So this is what I would suggest. Or one other thing you could do is you could take that money, and if you want to be really lazy, do that Apple high yield savings account. Okay, that might not be a bad place to do it. I don't know. There's a lot of things. I mean, I would love to sit there and find a way to show you how to put it into a whole life. But again, it really would just have to make sense. So there's 3 options, but I'm definitely going to say winner, winner, chicken dinners right there. Here's another thing I want to point out, and this is very important. Does anyone know why Apple can pay you 4.15%? Why can Apple pay you 4.15? Can anyone tell me? Stephen, I read that. Yeah, that's right. True. So Apple can pay you 4.15% because what Apple's going to do is when you deposit your $1 million in Apple, Apple's going to take your $1 million and they're going to literally go and they're going to buy T-bills and they're going to make 5.4. So here, they're going to make this is like printing money, 5.4 minus 4.15. And remember, they can change this rate anytime. So if this T-bill goes down, they can drop this. So what did they make? They made a whole 1.25% for doing nothing other than telling you, hey, put your money with us. We'll pay you 4.15. What they don't tell you is, hey, then we're going to take your money and we're going to put your money in treasury bills because we can, because they're backed by the full faith and credit of the United States government. And we're going to make a really quick 1.25%. Someone should look up how much money Apple, since they offered this high interest rate savings, how much money has been deposited into Apple. And then multiply that time roughly 1.25%. You'll fall out of your freaking chair. You see, this is all we do every single day, folks. It's not magic. Like, we don't teach you algorithmic, calculations on this and that. We don't teach you how to buy small cap, mid cap, large cap stocks. Oh my God, you got to look at this private REIT. You got to look at this inverse ETF. Bullshit. Screw all that. We show you how to do what the big guys are doing, and we just show you how to do it yourself, so you don't have to be the, you don't have to be the middle person. You go get it yourself. Okay, what else we got? Some questions. That was fun. What are some jokes? Anyone, as we're looking at the next questions, what are some jokes? It's all about the what. Like, you've heard different analogies. It's all about the Benjis. It's all about the what. Well, for us, it's all about the spread. When you become your own bank, it's all about the spread, because that's what we do. In the middle of everything we do, we're just looking to make a spread, and we're looking to make our money work for us again. So while we make the spread, we make money over here. When, this could be the cars we talked about. This could be the private loans we talk about. We just make money twice when everybody else makes money once. What's so complicated about that? Oh, and then by the way, yeah, we just changed where our money went first, and we already showed you the reasons why. Well, the reasons why are the same reasons why banks do what we do, the same reasons why the wealthy families of the country do that, the same reason why the sitting president, love him or hate him, puts his money into mass mutual whole life policies, public knowledge.
So when you're recapturing money, if you can't add the extra interest into your policy, because the policy's maxed out to the MEC limit, what are you doing with the remaining interest payments?
Great question. So let me come back over here. And this happens all the time. Matter of fact, I someday will write a book about this. So remember over here, if we take a loan for 17 or 36, the most we can put back is 17 or 36. But how we normally would do this is in the middle, there's always a stopping point, and that's going to be called a segregated bank account. We teach this, our mapping team does this. It's a checking account, okay? But it's a new checking account, a second checking account that's going to run all of your banking through it so that it's done. So what happens, and who is this asking that? Well, I don't remember who that was asking, but this segregated account over time is going to build up. Even though you're trying to send all the money back over here to your policy, you're not going to be able to put all the money over here because you'll MEC it. So this account starts building up, and that's where we start policy number 2. Policy number 3. And really, we don't call these policy 2, policy 3. We call them branch office 2, branch office 3. Why? Well, because we're mimicking what a bank does. And I don't know about any of you, but when I drive down the street in any direction from where my office is, I will see an M&T bank. And then about 2 blocks up, I'll see another M&T bank. And then about another 2 blocks up the other direction, I'll see another M&T bank. Why are there so many branch offices? The same basic reason. As you start building money up in the segregated account, you want to get it out of their bank and into your bank. And if your bank can't hold anymore because of the IRS rules, well, then you start the second bank and the third bank. And eventually something will happen where you can't put any more money in the policies for yourself. So what do? Well, honey, do you mind if we do some policies on you? Great. You use your significant other. Okay. Hey, little Vivi, can we do some policies on you? You start doing some policies there. Hey, Shauna, you're an executive. Can I do some policies on you? Hey, Steven, you're an executive now. Or actually, I'm going to promote you to the VP. And I start doing policies on Steven. You see, you just start building your banking system the same way the banks build theirs. Nothing different. I love Rob's question here. I have a VUL. Can it be converted to a whole life? Rob, couldn't have asked a better person. I had a VUL with New York Life. I started the policy in 2005. Why? Because when I was an advisor, that's just what we were told to sell. VULs, the greatest thing since sliced bread. Oh yeah, because IULs didn't exist back then. So an IUL, an index universal life, is literally like a bad spawn of a bad parent. The bad parent was a VUL like Rob and I had, okay? And that VUL failed in 2008. So it spawned an offspring called an IUL. And that offspring was supposed to be like the best of that world. And it's still just a dysfunctional little offspring. But Rob, so yes, I converted mine. I just did an exchange, a 1035 exchange from my VUL into a policy that I set up. And this was done, I think, about a year and a half ago, I did mine. The only thing I would urge you, Rob, is look at your VUL. Are you out of the surrender period? Some of those old VULs had like 15-year surrender periods. And that's how they get you in IULs and VULs. You got the money in there, but then you can't get it back out. So check your surrender chart or surrender period. And what that'll be is there'll be your actual cash value and then your surrender value. If the two are the same, giddy up and go, get on a call with us, book a call with Steven or any of our money mentors, and do a 1035 exchange from the VUL into a specially designed whole life. Great question. When selling real estate flips, do you typically put all your net profit into a new policy? Oh, George, I wish it were that easy, but no, because I have expenses, you know, in the real estate company. So some of the profit from selling my real estate stays in a corporate account, and then we pay bills and stuff. But eventually I'll be pretty much out of all the real estate that I have, and then I won't have to deal with that. And I will just put, believe me, as much money as I can, I get into policies. So it's just not 100% of it. It's just whatever. Me and the bookkeeper really sit down and we look at how much money do we need in reserves in the real estate company. Can the rest go into policies? You guys got great questions today. Are these questions helpful for everybody? Because we got some other stuff we got to hit. Steven.
Yeah, I was answering a bunch of them typing too. It's definitely a lot today.
Yeah, there's tons of them. Holy cow. Is everybody okay if I just keep going through the questions, or do you want me to kind of go into the next thing? Because I think Jerome Powell right now is speaking on what's going to happen with interest rates. And once we get that announcement, or we can see it on CNBC, I want to transition and I want to show you something really freaking cool. But is everybody getting a grasp of what we're doing here? We're creating a circle. We're changing where the money goes first, and we're putting the money in a specially designed whole life. And then we're just being the bank. And we're basically taking loans from our policy, which is the insurance company giving us our death benefit. We're taking it over here and we're putting that money to work in various different ways, you know, and this is what these trainings are. We have lots. I think I have 700 plus YouTube videos showing you a whole bunch of ways. And here's a new resource. I haven't showed this to anybody, but it's called BeYourOwnBank.com. So Steven, can you put that in the chat real quick? Just selfless plug. BeYourOwnBank.com. If you screw up and put Be Your Own Banker, it'll go to the same thing. So what this is, it's a brand new website that we just started creating. And what we're doing here is, if you're ever thinking, oh, what can I do to be my own bank? Like, I wonder what I can do. This site is all about that. So what does it mean to be your own bank? First is an explanation. Okay. Should I be my own bank? You know, all the different reasons. You can watch a video on that. But then it's going to go into the different things. Well, you could flip equipment like we have. We flip forklifts. Okay. You could go and do case studies like this one here. This is an airplane talking about how IBC could be used. But as time goes by, we're going to keep doing more and more case studies showing you how to use this. How do I use this policy and this infinite banking concept to pay off debt? How do I use it to do private lending? How do I use it to buy my cars? How do I use it to buy my boat? How do I use it to go on vacations? How do I use it for anything? Every video that we have is going to go in here, and it's going to be like a catalog. You know, remember back in the day when you were kids, you used to look through the Sears and Roebuck catalog, at least I'm showing my age a little bit, and I'd go through the toy section and I'd pick all the toys for my grandparents that I wanted for Christmas. Well, what you're going to be able to do here is it's going to be like a catalog, not a physical catalog, but you're literally going to be able to scroll through and be like, oh, I wonder what I want to do today. I wonder what I could do to, you know, with my money today in the policy. And you can just get ideas. That's all this is going to be for. So we're going to start working on that and building that out. What else we got, Steven?
When you make the payment to yourself, what happens at the end of 5 years to the payments you have been sending? Do you continue to pay that car payment forever?
No, because I mean, most people, Rick, after 5 years are going to want a new car. How I do it is I do the car payments. When I set the bill pay up, I set it up for the exact term, 60 months. So the payments go for 60 months. After 60 months, I know the payment's going to stop, but I know that I've gotten all the money back for the car plus all that interest, $14,000 in that one car example. Then on the other side, I've done loans, like me and Shauna were laughing the other day. Many years ago, I don't remember how many years ago it was, I made a loan to one of my old companies called Flip Out Academy. And that loan was used to cover payroll. And that loan still paid me all the way through last year, when that loan should have been paid off after 3 years, but it paid me way longer. Sometimes if I have the cash flow, I'll just leave the loans paying, because it's all going back to me. So it doesn't really matter. It's not like when you're making a car payment to Ally Bank, you can't wait to make your last car payment. When you're making a car payment to yourself, when you make that last payment, you're kind of upset. You're like, oh man, now I got to figure out where that money's going to go again. You know, it's a different realm. Let's see. Joe said, I pay my policy on an annual basis. The cash value hasn't changed since I struck the policy in April. When will the interest and dividends be paid on my cash value? Joe, that you're looking at something wrong, because the cash value goes up. The cash value should change every day, because the interest is compounded every day. So every day it's daily compounding. The dividends are only paid one time a year. I don't know what you're looking at or how you're getting the numbers, but your cash value never stays static. Your cash value is always changing based on, you make an annual deposit. And also it depends on the insurance company. I will agree, some of the insurance companies are a bit goofy on how they report the cash value. But if you call the mapping specialist, if your policy's through us, if you call the mapping specialist, they can get what's called a cash value quote or a cash value report and show you exactly where it is. I just had to do that with One America for one of mine. But like Mass Mutual, you can just go online and look at it. Security Mutual, you can go online and look. Lafayette, you can go online and look. One America was just the only one that was a bit hard for me to see my cash value today. And I'm sorry, Security Mutual was also another one that was hard. I had to actually get that report, but Security Mutual, I just called, and in 1 minute I had somebody on the phone. I told them what I wanted and they sent it over to me the next day. So I just think it's just what you're looking at to get it, because your cash value is always going up. Let's see. Could I use funds in a Roth IRA to fund a whole life policy? Yes, because your Roth IRA is tax-free, so you could take out your principal and put it into the policy. But I would argue why? Because your money's already in a tax-free vehicle. Why don't we just take it and move it into a self-directed IRA, which we can put in the chat. We can put, Brandy's email. You should talk to her about just doing a self-directed IRA, because you could just move the money into, a self-directed Roth, and then you could start lending it out and doing some of the stuff. But there are the self-dealing rules. And if you want to get around them, just take the money out of the Roth and put it into the whole life. But just make sure you're not going to trigger early penalties, which are typically 10% prior to 59.5. But in a Roth, after 5 years, you can use the excess principal. Man, these are great questions. George again said, awesome, thank you. Opening another policy for 60. Sounds like a good idea. Let us know and we'll help you do that. Brian said, thought so, but wondered if you found some trick. Yep, just like tricks. You remember that? The rabbit was always full of tricks. So we always got a trick up our sleeve. Keith, I'm on board with using the loan from the insurance when the insurance is higher than 5%, but what about when it's close to 0? Yeah, Keith, I think we were talking about the car before. We were using that car example with 3.3. If the car loan was 0 here, what I would do is I would revert to what I said earlier. Instead of taking the 17,000 out, I would take the full 53. So I would take 53,000, and I would just figure out, what do I got to earn on 53,000 to make that car payment? It's probably not much. Oh shoot, dude, you're going to get a raise. So I would take 53 grand, and I would loan that money on Private Money Club at 12%, or get the information from us for the Fullers at ROI Properties. They pay 12% with a personal guarantee. And that right there is going to produce $530 a month. Let's get rid of this house here. Let's get rid of this. So now what I've done is I've created $530 a month. I take 390 of it on that 0% car loan. So subtract 390. Okay, this is going to go to the car company. So that money's gone, but it's not your money anyway. So Rob Fuller and Nicole Fuller are making your car payment for you. But then the cool part is now you got a little extra money, $140 a month. And I know it's not a lot, but that'll pay for your Starbucks. That'll allow you and your wife to go out to the movies maybe once with popcorn. Inflation kind of did a number. I just went and saw Barbie with my wife last weekend. I couldn't believe what they charged for popcorn. That is not right. You guys want to really find something to get pissed about and argue about? Let's talk about the popcorn prices at Regal theaters. You really want to get pissed off? That's where we're going to get pissed off. Anyway, back to the questions. But see how I did that, Keith? Not hard. Just change. If it's 0, you could have even done that at the 3.3. If you didn't want, to take back the 3.3, just lend it all. And then that creates 530. Actually, that might be the better way to do it.
Do you need a medical exam if you 1035 from a VUL to a whole life?
Yes, but the rules will be a little different because you're doing a 1035. So the MEC rules are going to change on the money that you're 1035ing over. But yeah, on the new policy, Leah, you would still have to go through the medical to get approved.
Yeah, it's a new policy. So unless you qualify for like accelerated or something, but how would the whole life insurance work with a 55-year-old that is not the healthiest, high blood pressure, tobacco user, and overweight?
I mean, 55 is young for what we do. High blood pressure, no big deal as long as it's controlled. And usually it's always the same medication for high blood pressure. Tobacco, yeah, you're going to get a standard rating instead of a preferred, not the end of the world. There's certain companies we would use that are going to be more favorable for smokers than others. The overweight thing is the only thing that would scare me because we'd have to really look at the the body mass index, the BMI, and see, how that's going to play in. Because overweight is kind of, for some people, they think they're overweight. Like I could sit there and I could be like, man, I'm overweight, which by the BMI, I am. So I'm about 10 pounds overweight. Like, I mean, I think that's pretty good for being 10 pounds overweight, but there's different ways you could look at overweight. So we'd really probably anonymous. What we'd have to do is we could do what's called a pre-underwriting check, which basically we just give them some basic info, height and weight, the medication you're on and the milligrams you're doing, and then just tell them you're a smoker and just see what they come back at. Happy to do that. Book a call with us. We'll put that in the chat. I want to hit Hugo real quick because George has put a lot of questions. Hugo in the chat said, how soon after getting my whole life policy can I take out a loan? Now, let me quantify this. Hugo, if we design your policy, that would make it a specially designed and engineered policy. Every single time you'll be able to take your first loan immediately in the first 30 days. But if you go to your broke-ass brother-in-law or just a regular insurance agent, buy a whole life, the answer would probably be year three. Let's see, within 30 days. And then George, 340, recommend wait until I have 345. George, I would say probably book a call with one of our money mentors about your mortgage question. There's two different schools of thought for how to do that. And I don't know if I would save up all 345 and do that. I don't know because that would take a while. You could, but I could show you kind of like a different way, or watch the 90-minute video and watch how we do it with the chiropractor. Now, I know that's not your scenario, but just kind of start thinking like, if we could keep your money working for you up and then allow, kind of like how I did it here with the car, allow somebody else to allow our money to build up. So now we got a tailwind behind our money. That'll help pay your house off much quicker.
Yeah, I'm more of a fan of taking and investing and using the extra interest and profits to start paying down the mortgage. But
yeah, dude, look at how cool that worked for the car, right? Yeah. That was only 53 grand. So 53 grand at 12% gives $530 a month. His car payment was only 390. That's pretty sweet. So what would it take to make your mortgage payment? So I mean, if 53,000 is giving you 530, I don't know, George, chat in. How much is your monthly payment? We'll figure that out. But I want to keep this moving along because we're 2:15 already, and I got something really important because it's tied in directly with what's going on in the Fed. Stephen, I think I had talked earlier before we did this, and you pulled up a couple screenshots, and I forgot what ones I had you pull up. But you want to share those real quick, and so we can talk?
Yeah, we got TLT and we got Zeros.
Here's the thing, and I want to real quick. I just want to show everybody because I don't like just saying things without having the proof. So I'm just going to pull up CNBC here, and I'm just going to share this. I haven't even looked at this. But right there, we all knew this was going to happen today. Fed approved the hike that takes interest rates to the highest level in more than 22 years, 25 basis point hike. So what does that mean for all of you? Well, it means money just got more expensive. Your car loans are no longer 7.79%. Your credit cards, if they're not already maxed out at 29.9, then they're going to go higher. Your mortgage is going to go higher. Everything's going to go higher. They're trying to slow the economy down. So how do you play into this? I think is the real question we all should be asking. How do you play into this? Oh, Dominic, hold on. Let me transition and get Dominic's question. You're speaking on the pros. What are the cons? Okay, what are the cons? Well, we kind of hit some of them. You might not get approved for a policy. So if you're overweight, if you got medical conditions, you might not get approved. Dominic, that would be probably the first thing. You can't get the policy. It's not the end of the world because you can do it on your wife and your children. But the biggest problem, the biggest con to doing what we're talking about is the money that you put into the policy, you're not going to have access to 100% of the money. So let me just show you. I did a video and you can look at it. It's how to design an IBC policy updated, but these are the things. So these are all based on $10,000. These are 4 different designs. If I did a 60-40, 60 PUA, 40 base, whether you know what that is, if I put 10 grand in, I only have 6,500 to use. If I do a 75-25, if I put 10 grand in, I only have 7,600 to use. If I do the Slayer, I have on the 10, I have 6,900. And if I do a 1090, which we don't do many, I have 8,800. So what's the downside? In the first 2, sometimes 3 years, you're not going to have access to all of the money that you put into the policy. And if that's a deal killer, then, well, this doesn't work for you. That's a con. But what you're giving up is, just look here, okay? So this year, in the 5th year, I put 10,000 in and I take 10,573 out. The 10th year, I put 10,000 in, I take 13,000 out. But what I had to do is wait those 3 years to have that tailwind and have compound interest working for me. But here's the kicker. Remember, these numbers work whether the money's in the policy or not in the policy. So that's the differentiator. So that's where it comes very hard for me to justify the con without talking about the pro. If I have to give up 3 years of a little bit of my money in this example, like I put 10 in and I only have 7,600 in the first year. Some people, that's a deal killer. But for most people, they're like, okay, well, what do I get later for giving up a little in the early years? Well, you get compound interest for the rest of your life. And that should be all I have to say. But I get to use this 7,600 bucks and still get paid on the full 7,600 bucks. So I can take this 7,600 bucks out of the policy and I can pay down a credit card that's 29%. I can recapture the money from the credit card over, but I'm still earning interest and dividends on the full 7,600. So even though you don't have all of it, this is one of the only places on earth that you can put your money in and take your money out. So you can save and spend at the same time without interrupting any of the interest you're earning. So we do talk about the cons quite often, but the cons are so difficult to really justify like why you would call it a con, because the future gains that come out of waiting a couple of years to have access to all of your money. And also too, some people might say, well, yeah, but why don't you have access to all of your money? It's called a death benefit, folks. If you died tomorrow after your policy started, your family gets a big death benefit. And if you don't take that seriously, and if you don't see value in that, then we probably can't be friends. Quite simple, because your family should come first. Can anyone tell me the best way? There's 3 rules Warren Buffett says that every investor should know. What are they? How do you make money investing? Okay, don't lose money. That's the 3rd one. Okay, so don't lose money. Stephen, just read them off as they put them up. What is the 1st and the 2nd?
Well, let's see. Buy low, sell high.
Yep. So the 1st one must be buy low, because we can't buy high first, right? We got to buy low. And then 2, we got to sell high. Does anyone disagree with those 3 principles? Anyone? Anyone at all think that it should be a different order? Does anyone think that this is not the way to make money investing? Because it is very
It depends on what you're buying. I mean, if you're buying puts, it might be a little different. But
yeah, let's not talk options today. We'll lose the whole audience. If we can all agree that buy low, sell high, and don't lose money is the way to do it, then what is low right now? What investment can you buy that's low? Let's just do a little roll call since we got some time. Can you buy real estate cheap right now? No. Can you buy large cap stocks, small cap stocks, mid cap stocks? Can you buy those low right now? No. Oh, see, you guys are getting ahead of me. Bonds. Oh, okay. You can buy bonds low? All right. So bonds, if we're going to buy them low, we're going to talk bonds. And specifically, long duration bonds, okay, are the best ones, but really any bonds. And we'll just put long duration treasuries. And what should you sell right now? Can anyone think what's high right now? We talk about this all the time. Matter of fact, we hit it hard today in WTF, which is a show we do every Wednesday morning. That's right. Dana said stocks. You'd be hard pressed to find any stock, any mutual fund, or any ETF that is not sitting around the 52-week high. You'd be hard pressed not to find that. So can we all just agree that selling high would be basically sell your stocks and you'd be selling high, right? And if we just bought low and sold high, well then, duh, you can't lose money. So it's a very simple formula. So now everybody's talking about bonds. So now let's get into this. We know let's hit the facts. We know for fact the Fed just raised interest rates again. I think that's the 11th increase. So we know for a fact that that's true. So hold on, I got to find, we'll use this one. Just got to bring my chart up here real quick. This whole training, I'm not going to get into it, but this whole training was from our last Money School Essentials 3-day training. And we're only going to talk about this. So there's a unique dynamic that might only happen one time in the 127 people that are on here in your lifetime. This might be the only time in your life that you'll ever have this opportunity. So I want you to listen very carefully, because your advisor is going to tell you something different. If you ask them, if you tell them what I tell you to do, they're going to go against this. They're going to say that's a stupid idea. They're going to say that guy, Chris Naugle and Stephen Nagy don't know what they're talking about. But I assure you, I promise you, we know exactly what we're talking about. Both of us had our Series 7 stockbroker license, okay? Both of us. I also had, I think you did 63 and 66, and I had a bunch of numbers after my name. So when we got that, one of the biggest pieces of the Series 7 stockbroker exam is bonds. The inverse relationship of bonds to interest rates. You remember that, Stephen? Remember Series 7? Like the majority of that ginormous book was bonds. It was almost like you were just so sick of talking about bonds, but it was talking about this exact moment. But most financial advisors, because it's not sexy, most advisors don't want to talk about it. They want you to invest in stocks. How do I know this? I have a client that has over $1 million. She just retired, got her 401k, or it was actually her government account, her retirement account, rolled over to Charles Schwab. She worked with a Charles Schwab advisor, and they invested her. She's a very conservative investor. She's told me, she said, I can't lose money. And they invested her in what I would call a high risk investment portfolio that consisted of all but one Schwab investments. A Schwab advisor put her in almost 100% Schwab investments. Funny how that works, but didn't listen to her needs and goals at all. Just invested her in the riskiest stuff and bought freaking high. So what I told her to do is I said, here, Stephen, can you pull that chart up that we have?
Yeah.
TLT.
Which one? TLT?
Pull up TLT. So all of you can find this, and I'm not making a recommendation or a suggestion here. This is being recorded. I want you all to know I'm not suggesting you buy or invest in this. I'm just telling you this is what I do. Okay. This is an ETF that I have been buying for the better part of almost a year and a half now. It's called the iShares 20-year plus treasury bond. Just an ETF, really inexpensive. I got a whole list of treasury bond ETFs that you all can buy or that I buy. But all I want to do is I just want to go to max. Now, listen, I don't care if you're a stock person, a mutual fund person. I don't care if you don't know a damn thing about stocks or bonds or investments. Can you just look at that chart right now? What do you see that should be blatantly obvious about the here and the now? The far right side of that chart represents today. What is the number one thing? Holy cow, I had a good day in that. Look at that. Sucker went way up today. But just look over there. Can anyone tell me what you're looking at? What is that? It should be very simple. Come on. We're not going to move on until someone tells me what they're looking at when they look at this chart. What do you see? That's right. A cliff. It's low. Look at the whole chart. Go back. I mean, we can only go back to max on this one, whatever, early 2000s, but
2002.
This is pretty much one of the lowest points this has ever been at in a market that's at its 52-week high. So if I'm looking to buy something low, here it is. But you don't want iShares. Stephen, can you pull up Zeros? There you go. How about this one? 30-year, zero coupon bonds, which means I get paid no interest on these bonds. How about that one? Oh, yeah. That sucker's way down. Had a good day on this one today, too. Wow. Shoot. Starbucks is on me tomorrow. Look at that. Low. So all I want to show you is factually that what the Fed is doing right now by raising interest rates is literally creating an amazing opportunity for every single one of you. And I also want to be clear that we make absolutely nothing on giving you this advice. This is just smart. So I have nothing to gain by telling you to do this. Nothing at all. I mean, iShares or PIMCO or whoever you decide to go with, they have something to gain. I have nothing. But I'm telling you this because nobody else will tell you this because they can't get paid on it. This is an unbelievable buying opportunity, one that I don't think I'll ever see in my lifetime, and one that is created because the Fed has gone on a crazy tear to tame inflation by raising interest rates. And it just ridiculously, I don't even know if it's unprecedented, but unprecedented actions. 11 rate increases in just over a year. We have gone from close to 0 to over 5% in rates and another 25 basis points today. All I can tell you is I'm not the only one that knows this. You know who else knows that this is an opportunity? Insurance companies. You know who else? All the wealthy individuals out there, institutions, hedge funds. They all know. The only person that doesn't know, that seems to not know, is your stupid financial advisor. Excuse me, I know they're probably your friend, but they don't, for some reason, know this, because if they did, they've been calling you. They would have been telling you to get your money out of stocks, so you sell high, and move it into treasury bonds, because this is a rare opportunity. Now, some of you still don't understand the opportunity. So let me break it down. It's right here. And I'm just going to share my screen big so you guys can see the whole thing. And then you guys can go and do whatever you are. And the only thing that would piss me off more than anything is not the price of popcorn at Regal. It would piss me off if none of you actually act on this knowledge, because that would really make me sad. It would make me so sad, because I have got nothing to gain. I'm pouring my heart out giving you something. It just so happened that today at 1 o'clock, we knew the Fed was going to make this announcement. And we've been telling you that the Fed's going to start raising rates. And that created a cool opportunity for everyone. Again, interest rates have been going up. Okay. Interest rates have been going up, which means the price of the bonds have been going down. I just showed you that, creating a buying opportunity. So down here, all I'm going to do on this is I'm just going to write buy. Okay. Now, what will happen in the future? And you guys can all go to Yahoo Finance and you can read an article by someone way smarter than me and probably wears a suit every day. So some of you, judge people by what they wear, and you want somebody with a suit, you can look at them, and he will tell you what's going to happen next. The United States will enter a recession. Oh, sorry, we're already in one, but yes, we are going to know that we're in a recession within the next year. Probably 2024, we'll start seeing what we know to be a recession. And when we go into a recession, a couple other things are going to happen from now until then. The Fed is going to keep raising rates. The Fed is going to keep making it difficult to get money by controlling monetary, supply or money supply and monetary policy. And by doing that, it's going to make it very difficult for all of us to get more money from banks. It's going to make it very expensive for us to buy the things, which means we're going to stop buying things. We're going to stop buying all those things. Instead of going out and buying the new car, we're just going to drive the existing one. Instead of going out and building the new house, well, we're just live in our house because we got a low interest rate. Hence why we have so much demand in real estate. And when all that happens, the Fed will get their wish. They will have tamed inflation that they created. Oh, yes, they did create it by printing $5.1 trillion. They created the mess. Then they said it was transitory. And then all of a sudden they said, oh, yep, it's a problem. We're going to solve it. And then they inflicted pain. And they actually said that you're going to feel some pain in there. And you feel the pain every day you go to the grocery store and every day you try to buy something. But when we are in a recession, the Fed will do what they have done every other time since 1913. And just so you all know, 1913 is when the Fed came into existence. They will lower interest rates. They will drop interest rates. And what in the world do you think will happen when they lower interest rates to the price of those bonds that you bought low? Oh, you bet your sweet ass they're going to go up. Stephen, show the chart again. I'll prove it. This isn't rocket science, folks. This is not rocket science at all. If you can draw an X, you can understand this. Here we go. 2008. Where is it? Right there. We all know 2008. What did the Fed do when the recession hit? Okay. And the recession really kicked in 2009. So if you can just scroll over a little bit to the right. Okay. Probably right about here. Oh, holy, what just happened there? My goodness gracious. What is that thing? Well, that is when the Fed dropped interest rates. So you could look at those dates. You go down just a tad. And any of you are welcome to do your own due diligence. Go to, I don't know, October to November of 2008. And I want you to look at the news headlines and I want you to realize one thing. The Fed was lowering interest rates. And because the Fed was dropping interest rates quickly, it spiked Treasury bond prices. And that happened again a bunch of other times. 2014, most of you don't even know, but that was the Euro crisis. Remember when Greece was going bankrupt? Boom, right there, dropped interest rates. Okay, then all of you lived through the pandemic. Look at that. There's the pandemic. They dropped interest rates to close to zero. Go way over there, right there, Stephen, to the pandemic. Just look at these dates. There it is, okay? That right there is the pandemic fall. And then right after that, look at that. That's like, man, that's a pretty steep cliff. What happened? They took interest rates from, I think it was around 4 to 0. And what happened to the price of your bonds? They skyrocketed. And then what's happened since then? Prices come down, 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 down. You don't have to be good at picking stocks here, folks. You don't even have to understand anything. You don't have to understand anything except for buy low, sell high, and don't lose money. And the only thing you got to do if you buy treasury bonds is you just got to watch the news. And not even every day. Just pay attention. I mean, you'll hear it. Social media will say the Fed's dropping interest rates. And when they drop interest rates, all you got to do is for the first time since you opened your Schwab or TD Ameritrade account or wherever you buy these, you're actually going to log into your account if you can remember the password and username, and you're going to look at your account. And miraculous, surprisingly, what's going to happen is you're going to have a bunch more money than you thought was possible. Because if just simple mathematics happen, you should make about 30 to 40%. If we just look at the past and we go there. Risk-free. I did say that. 30% risk-free. See, I'm not in the risk game. I'm risk averse. I like the no risk game, which is why I play in treasury bonds, why I buy whole life policies that are guaranteed. So George said, if I'm losing 35, was that helpful, folks? I hope so. I mean, I felt like I gave you guys I literally felt like I gave you the recipe for Heinz 57 ketchup. Like I feel like that's the equivalent of what I just did. And I don't think you guys are as excited as I am. Now you guys are, because now I'm calling you out. I think some of you are maybe asleep. You're like, I don't understand this stuff. Well, you don't need to. Like, just go online and look it up. George, if I'm loaning $35,000 at 15% on a deal in Private Money Club, does that essentially mean that I'm making 20% on my money, 5% compound interest in the policy and 15% simple interest? No, George, because what we got to do with the 5% compound interest you're making is we got to subtract what the insurance company is charging you. You're making more than 5%. And then we just have to look and do the math and see what you're making, the spread. Remember I said it's all about the spread. And then add that to the 15%, but you are making money twice. And every year that goes by, the longer you have the policy, the more you're making in the spread because of compound interest. And then Rob said, can you buy these from a traditional IRA? Oh, yeah. You can totally buy these. And almost all your traditional IRAs, even most of your 401ks should have some type of money market or bond fund that's tied to treasuries. So just look, or just call your 401k, call your IRA provider, call your financial advisor, and ask them to sell high, which means sell just about everything they buy for you, because most every advisor has been just buying stocks for you, which is like leading you off of a cliff, and tell them to buy bonds, treasury bonds, intermediate term to long-term treasury bonds. There's all sorts of them. Like, they'll try to talk you out of this, folks. They will. They'll try to tell you that we're not going to go into a recession. They'll try to tell you that there's nothing to worry about. You got to invest for the long haul. And I'll just sit there. Like, if that's what they tell you, fire their ass. Like, why would you want an advisor that isn't giving you the right financial advice? Oh, you're in this for the long haul. Great. So hold on a second. Here's what that means. Let's listen to our financial advisor, who's a lazy son of a bitch, and let's listen to them, and let's just be in this for the long haul. You're here, X marks the spot, 52-week high, okay? Chances are eventually here's where you're going to be. So we're going to ride this roller coaster down. Now, depending on who you're looking at, it's probably a 40 to 67% fall, okay? So you're going to ride it down, but let's just do 40%. Let's pretend you're in a diversified portfolio. Oh, you're in this for the long haul. You're diversified. You're only going to lose 40 when everybody else loses 67, okay? How much money do you need to make back just to get the 40 you lost? Can you all see this? Can you all read that? If you lose 40, you have to make 67 back. Hold on, maybe that didn't sink in. If you lose 40, you have to make 67 just to get the 40 back. You have 40% less money, which means your 40% less money needs to work 67% harder. Why the hell would you ever do that when all you need to do is build a bridge called treasury bonds, make money the whole freaking time, and you don't have to work as hard? Who am I? I'm just the guy with the baseball hat, the long hair, and the tie-dye looking shirt who doesn't know a damn thing. It's very important that some of you and some of the folks that you surround yourself with start really thinking about who is giving them the honest truth and who is actually just trying to collect a paycheck. With that being said, folks, we have an awesome event happening next week. It's Money Tank. It's out in Raleigh, North Carolina. Some of you are from North Carolina. You need to come. I know a couple of people had bought today, but we also have a virtual option. You can join us virtually from the comfort of your couch, and we'll give you a discount code today. So that's only $97 to join us virtually. And outside of that, we do 5 webinars, sometimes 8, sometimes more, every single week. And next week, we're doing another webinar. What is that? Tuesdays at 6 p.m.? Tuesday at 6 p.m. to dive deeper into how to make somebody else pay your car payment. What else, Stephen? What else we got? I know we're over time.
I love it, man. No, I don't have anything else. It's perfect.
So folks, I really hope for all of you that you just apply this information. That's all I ask. How many of you can agree right here and right now that you're going to apply something that you learned today? Put I in the chat. You can even lie to me to make me feel good. I know Terry already is.
Sorry, I actually just bought TLT while you were talking.
There's one. So now I feel good. Because it would be a damn shame if you don't just act on something. I don't care if it's a little bit or a lot, but if this didn't wake you up a little bit, and really just even for some of you, if this just didn't get you to just go and look at your 401k or look at your investment accounts to say, I wonder what's going on there. You're going to look at it, and I just want you to know, don't be blinded. You're going to look at a high number, like your value should be a pretty high number. That means sell. And that's all I can tell you. And then reallocate it into something that you know for a fact is going to make you money, and you're going to be paid the whole time. Because TLT does, what is TLT yielding right now? I don't even know. It's probably 2-3%. All right, well, with that being said, folks, some of you join us. If you have questions on any of this stuff, join us at 4:30 Eastern today. You can do that by subscribing to my YouTube channel. Make sure you click the alerts button up top, smash that alert button, and you'll be notified when we go live and when I put up new videos, because we're putting new videos up every single day. So check it out. Join us for Ask Me Anything's happy hour, where we'll answer all your questions. And outside of that, go out, live your best life, learn how to make your money work for you, and take back control of your money. That's all we got today. Thank you, Stephen. Thank you, team. And thank you to all of you for your time that you spent with us today. We'll see you on the next Wealth Webinar. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.